Let me turn now back to our program. Although the role of emerging markets in the global economy undoubtedly is going to be critical in the years to come, there's still a lot of discussion about what the prospects are for today's emerging economies, especially after the global economic crisis. Originally, people were very excited that emerging markets were actually helping lead the country out of global recession. There seemed to be a kind of a decoupling of the linkage between the performance in emerging markets and the developed world. But that doesn't seem to be holding as fast as the slowdown continues. And so some people have already said, emerging markets have seen their best days and are going to decline. Or some of the key ones are hitting real serious barriers to future growth. So it's very appropriate, I think, today that we start the conversation of the new institute with a big picture view of really what is the global context for the economic prospects for emerging markets going forward. And of course, that will inform a lot of the way we think about much more specific issues about what emerging markets need to do to meet these global challenges that Jay, I think, highlighted in his remarks. So we have three fantastic speakers to help us get started. And what we're going to do is allow each of the speakers to speak for about 20 to 25 minutes. Please don't go beyond that. I'll try to signal you. I don't know if we have a timekeeper here. Do we have a timekeeper here? No, okay. And then after that, I'll invite the three speakers up to the front, and we'll continue the discussion with some questions, and then open it up for Q&A from the audience before closing. So let me introduce the first speaker, who is Jan Svejnar. Jan, there are program notes which, of course, describe the illustrious kind of background of each speaker. So I won't go through all of the details. You can read the notes. Jan is currently the James Shotwell Professor of Global Political Economy and founding director of the Center on Global Economic Governance at Columbia University's School of International and Public Affairs. And Jan is very well known for his research on economies in transition. Originally, now his scope is much broader, I think. But originally from the Czech Republic, is very much an expert on Eastern Europe, former Soviet economies, and was famously a candidate for the presidency of the Czech Republic in 2008 and came a whisker, I think, from winning. It's probably lucky for us that now he can come and join events like this as a professor. So Jan is going to be talking about effects of the global economic situation on emerging market economies. So Jan.
Well, thank you very much, Albert. Thank you, all the organizers. It's a great pleasure to be here. I should start by congratulating HKUST on recruiting Albert. He is one of the most renowned development economists, foremost specialist on China and emerging markets. And so it's wonderful to see him being in charge of the new institute. And I'd like to congratulate at the same time Ernst & Young for co-sponsoring the institute. I think it's a brilliant idea. And I think you are far-sighted in going exactly for this orientation. So I'd like to certainly second your efforts. In full disclosure, I should mention that I like Ernst & Young personally as well. They happen to support the center in Prague that I happen to use the logo of, so it's great for that as well. And I happen to chair a supervisory board of a large bank, CSOB, and they're our auditors. So in full disclosure, it's a great company on all counts. Great. So I will do just exactly as Albert said. Go quickly over some of the main points, raise it as questions so that we can discuss it in the part. So I'll talk a little bit about emerging markets and the global economy. I'll focus also a little bit as an example on the East Central European or Central East European CEE countries and conclude with the main points. So if you look at the global economy as we've been looking at it so far, it looks like it's now going perhaps from 2 to a 3-speed type economy, or multi-speed in some sense. So some of the developed countries, the European Union in particular, are unlikely to grow fast, at least in the near future. And I'll talk about that a little bit. There are problems with economic nationalism, the Doha round conclusion, the Bali package promise may not be realized. Trade policies focusing increasingly on selective liberalizations, the free trade areas, special partnerships. So the question is, will it be, in fact, a situation where we try to liberalize trade further generally, or is it going to be more, as we saw, special partnerships, one-on-one, or several countries together? Okay. There is the issue of weaker exchange rates on the part of some of the developed countries, and the concern of global macroeconomic imbalances that may bring about. And I would say overall, there is an incredible inability that we've seen when the financial crisis hit and the recession propagated itself, inability to coordinate even in crisis on the part of the large economies. So I would say there is a crisis of leadership in the sense that the large economies were unable to agree on even some rudimentary set of common policies. As it turned out, there were some automatic stabilizers that came into force that happened to be correlated across these countries, like unemployment benefits and so on and so forth. But when you saw Barack Obama's first trip to Europe, he tried to see if they could coordinate and basically capitulated. There was no way to find cooperation on the part of the other countries. Okay, so this is roughly how the picture looks. Last year's growth, the forecast for 2013, and forecast for 2014. I should just point out that if we looked at this picture last year, it would be exactly like that. In other words, expecting growth a year later. Okay, it just has not materialized to the same extent that everybody expected. So as you can see, very varied performance. The emerging markets generally growing much faster, okay, than the advanced economies. But in the advanced economies, the US, for instance, doing better. It's not satisfactory, but it's doing better in terms of economic growth than the EMU, which is the Eurozone countries that are in recession, and some of them in Southern Europe in very severe recession actually for quite a while. Some, like France, teetering on stagnation, possibly a dip. Germany doing relatively well, but not all that well either. So as you can see, indeed, the world is different. The question is, can the emerging markets, all of them, some of the countries, pull the world or do well on their own compared to the rest of the world, which is not in a very happy situation. Okay. So here is the private financial flows. As you can see, they've been growing over time, then kind of zigzagging for a while, going down recently, possibly going up as well. When we decompose it into direct investment, as we can see, there was a steady increase. Then from about 2007 or so, it's kind of up and down, if you want, a steady line. So the question is, what's going to happen? Will it be increasing or not? And will the flows, therefore, to emerging markets be increasing? The other two lines, the blue and green, are essentially the portfolio and other private financial flows, which have also portfolio-type character and are important for some countries, especially those that don't have developed financial markets. And those have been the part that's been pulling things down recently. So it's good to keep that in mind. And so the question is, can we keep this outward orientation? That appeared to be the right approach for the emerging markets for a long time. You would have a good business environment that you create, foreign investment will come in, you get profits from exports to advanced economies, right? And the benefits are that GDP growth will come in, and there will be important spillover effects from both trade and FDI. So you benefit both directly in terms of GDP growth and the spillover effects, learning, and other things. Okay? So there are wider implications that are sort of benefits of this interaction, this global interaction. So what is the challenge to this? Well, the traditional destinations, especially the European Union, as we saw, are likely to grow very slowly, if at all. right? There is increasing global instability. The variance of various indicators has increased dramatically, and credit financing for export is often harder to come by than it used to be before. Some of the emerging market economies are also becoming larger, which is the result of their success. So that's terrific, but that means they're becoming larger also relative to the export markets. So it's a little bit different from being a small, almost indistinguishable player. The FDI has recovered, as we saw, but will it grow as before the crisis or not? It's kind of been stagnant up and down over the last 5-6 years. So the question is, can the emerging markets overcome the challenge by focusing more on perhaps other emerging markets? And I think that was also already what Jay mentioned here, both for exports and source of capital. And more broadly, is a revision of the traditional development model or paradigm something that we should be thinking about? Is that needed? Right? So can the EMEs switch exports to other EMEs? Well, there are some some of it definitely can be done, right? But we shouldn't forget that there are some strong emerging market economies that are sensitive also to the performance of the advanced economies. So that effect still will be felt. It's already felt. And unless the advanced economies recover faster, that effect will be cumulatively felt. So we have to take that into account as well, right? Some have not yet switched substantially from export orientation to domestic demand, and China is often mentioned as being in the process of doing that, and that may have an important effect on others in the process. And the question is, if we do this, if the countries switch and go to the emerging markets more, will the spillovers be as strong? Right? And we saw some pictures on R&D in Jay's presentation. And so indeed, there is a question whether the new market investors will provide benefits, less tangible benefits that are as important for economic cooperation. Some of the examples actually that we've seen in empirical research is that some of these investors can really provide quite strong benefits. So that's very good. I put here an example of Turkey as a country that I recently went to advise. The government invited me to talk to them. I was there actually 5 years ago as well. So it's interesting to see a country that really is on the move, has diversified dramatically. It was basically oriented towards the European Union, where it thought it would be mostly entering. Given that that has been delayed, it's adopted a 360 degrees policy and is exporting very significantly to the Middle East and to Central Asia, etc. So it's an example which has been growing, country has been growing quite fast and doing very well by diversifying their exports and, in fact, even source of FDI. So there are some additional issues that are useful to mention here. There is the question of institutional development or policies and institutions. Right? It's worth thinking about it because the advanced economies, the ones that have the problems that we see, were in some sense the role models for the emerging markets, right? Now they've had very visible regulatory failures of various kinds. The euro crisis is highly visible. So that has impaired, these have impaired this leading role or role model. The question is, are there alternatives? What are the alternatives? The same issues are relevant for reform of the global economic governance and its institutions. You can take the public ones like the International Monetary Fund or G20. Are they appropriate? Do they need to be revised in order to be really more responsive to what we need? There are important private players. The rating agencies have been playing an incredibly important part without much regulation, both within the financial or leading up to the financial crisis in the United States and subsequently downgrading countries and so on and so forth, therefore having a major effect on governance, economic governance in the world. And then there are, of course, security and strategic concerns. As you diversify your exports across different countries, the question arises of how different, or is there a difference in reliance on different types of markets, right? The US, the EU, fragmented as it is, China, Russia, Brazil, are obviously different types of markets in terms of the institutions, the strategic concerns, and so on that come along. So I think those are the important issues to have. So can the the EMEs partially replace foreign direct investment if it should not be rising as it was in the past domestically? The first order of magnitude or first cut-off answer is yes. Gross savings exceed investment actually on average. And the question is, the savings rate already is very high. So can you actually go higher than that? Is it desirable to go higher than that? So I think these are important issues. I think it also is crucial to realize that foreign capital is likely to remain attractive. It brings not only money, but brings skills, improved corporate governance, access to distribution networks worldwide, and so on. So to remain attractive for foreign investors will be crucial for many emerging market economies, and that's foreign investors from the advanced countries. So remaining global, being part of the entire network, I think will be important going forward. So here's the picture of the investment and gross national savings, and as you see, the gross national savings are a bit above the investment level overall. So how to continue? So one aspect that people are stressing increasingly is that productivity, higher efficiency of resource allocation is the way to go. In some countries, it means focusing on containing corruption. That is more important as a feature in some countries than others. So in those countries, that's the issue. Financial system reform is very important in a number of countries, and so on and so forth. So each country has its specificity, but there are certain areas that certainly lend themselves to more general targeting. The question of the survival of the World Trade Organization and multilateral trade system. Right? Can that be achieved, or is it going to be more the compartmentalization that we have seen? And if so, then it's going to be very important of which clubs the country will be part of. And obviously, the respect for the rules by all countries is very important for the survival of WTO and the free trading system to be there. There is the reform of the IMF and the global mechanisms and focus on macroeconomic imbalances, very important issue, unresolved right now. And all this requires significant coordination and leadership. I'm coming back to my issue, do we have a crisis of leadership here or not? And I think leadership is an important issue that has to be stressed. So let me just give you briefly in the few minutes that I have remaining some examples from the Central Eastern European countries, which are quite interesting. It's a special subset of emerging market economies, right? They came from a centrally planned type system. They turned their trade from east to west almost literally completely within a matter of a couple of years. So they showed that one can do major reorientation quite fast. It's not easy, it's not costless, and so on and so forth, but it can be done. And they have been the fastest growing part of the European Union until the crisis hit. Incidentally, they did not have the financial crisis. They were hit in the second round when the recession set in after the financial crisis imparted the recession on the advanced economies. They are extremely dependent on one particular market, namely the EU. So, for instance, the Czech Republic, 85% of the exports goes to the EU. And there is often indirect trade with other countries, China, India, but it's usually through the EU. So they supply the EU, and the companies there then export to India or China. So their products do go further, but usually through that. So EU has also been the main source of investment before the financial crisis, so there is a significant degree of concentration, specialization, which has made the countries be quite vulnerable in the last few years. Their engine of growth has been a combination of low cost, yet educated labor, plus FDI, and the FDI came primarily from EU, and that has then led to exports to EU as well as non-EU markets. Okay. It's nowadays, of course, difficult for them to achieve fast growth without a growing export market, and obviously, as we saw, their export market is not growing, and in some sense, in some areas, it's declining. So what is the comparative advantage for these Central East European countries in terms of the original model? They have the locational rent being located very well in the EU or proximity to the EU, and that has helped a lot. More and more of them are becoming EU members. They have this lower costs of production than the old EU members, the Western members, and they have relatively highly educated labor. The question is, has this growth model broken down now with the situation that we have in the advanced part of Europe? Is there a different speed of recovery? Should these countries be looking for an alternative model? And what is their comparative advantage if they actually look elsewhere? Right? So this is an example of Germany, which is the main recipient of exports from Central Eastern Europe and also main investor in that part of the world. As you can see, it's a mild growth, and then you have the euro area, which actually is in a recession. So what are the alternative models of growth for these countries? So is higher FDI inflow needed to sustain growth? Or can these countries just become more efficient and not need as much investment? Right? Can they remain attractive for you investors? Presumably yes. What are the alternative sources of investment? So they're exploring various other countries. They do have contacts. They do have already activities there. But obviously, they would have to expand in a major way. So the Czech export strategy, for instance, in looking for the more dynamic markets, is focused on China and Russia. There are other countries as well, but these have been singled out. The problem that these countries and any other economies, incidentally, are encountering is that the trade, which in this case is centered on the European Union and Germany in particular, is logical in the sense that it is in line with the standard gravity model. Just the proximity and where you would tend to export given the differences in income per capita and so on and so forth. So changes are possible, but they are likely to be slow and costly. Okay? So if the countries want to do it, they can do it, but it is not something that they would do on their own if they didn't have to in terms of how trade flows normally go. So let me just summarize with sort of overall conclusions, drawing together both the Central European and generally things. So I think that the advanced economies are really suffering from what I call crisis of leadership here. And that leads to slow growth and will lead to slow growth in large parts of the world economy. Just sheer orders of magnitude, the European Union is roughly a quarter of world GDP. Okay? So that part is stagnant. The US is almost another quarter, right? So you have half of the world economy that's doing so-so or not very well at all. And then you have, of course, other pockets, Japan, et cetera, that are trying to get out of a malaise but have had a hard time. So dynamic smaller economies, I think, are able to continue their approach. Okay, they can increase their efficiency, focus on that. But there will be some other emerging market economies that may need to adjust their existing model. They will find that essentially they will not get too far if they continue that. There is not a universal panacea. They will each have to find their way. The Turks, as I gave an example, did actually very well by diversifying regionally around them and are becoming a hub, a major point within the whole region. Okay, you have to realize that not all economic partners are equal, which is fine, but you have to find the appropriate relationship in that. And the last point I'd like to stress is that global cooperation is important. So even though these countries are competing and will be competing on many markets, there are benefits from continued trade liberalization, from improving global economic governance. So that's an area or areas such as these, and there are others, where engaging in global cooperation is really important. So let me stop here and let me thank you.